Hi friend, welcome to Zero Life. Zero Life is defining one of the most important concepts today, which is the Indian capital market. Here, you need to understand the system. Market is need to understand, it not to predict. Here, we will understand the entire life cycle of stock market. We'll understand what is the difference between shares and stock. We will understand what is the company and how stock market work. Let's begin with one by one. Let's say XYZ Limited. There is a company, two-person, A and B. Both decided to start a business. Both decided to start a business. Let's say textile business. Let's say textile company. Now they need money to start a business. They need money to start a business. What they told that A told, I will bring 6 lakh rupees to the business, and B told, I will bring 4 lakh to the business. Now the total business money for the business is 10 lakh rupees. Both decided that A told that whatever business is, I will own 60% of that business, and B told whatever the business is, I will own 40% of the business. So the ratio is 60-40. And the same way, the initially they come into conclusion that let's divide that 10 lakh into shares, or let's divide the entire company ownership into shares. And now the ratio is 60-40. So based on the money they bought, 6 lakh bought by A, 4 lakh bought by B. So what they do, I hold 60,000 shares of XYZ Limited, and B told I will hold 40,000 shares of XYZ Limited, and each shares price is 10 rupees per share. That 10 rupees is basically called the book value, like face value of the share is 10 rupees. And they went to reputed professional from the company, and they told that they interested to form a company, and they form a company. Now here need to understand what is a company. A company is a company which is formed and registered under Companies Act is called a company. It is not like some fancy thing. Anything which is come and registered under the Companies Act, it has to call as a company. And there are various criteria how to form a company that we will discuss in the later section. Now both went to a professional and they intended to form a company. Both bought they have the money, they are qualified to form a company, and they started. Here two people is there, and they are forming a private limited company. Here the most important thing is, for company there are two type of company. One is private limited company, and second is the public limited company. A private limited is the company which required minimum two member. Means members mean here shareholder. They required minimum two shareholder who hold the ownership of the entire company is the private limited. Minimum 2, maximum 200. And for public is minimum 7, maximum unlimited. So first we understand private, then we go for public. Then we will understand what is the listed public and the unlisted public company. So the journey started, and they went and they form a company, it is a private limited company. Now the company has started. They've got the certificate of incorporation, they got the bank account, and whatever money they agreed in the form of share capital, they have given to the company. Here understand, company is a separate legal entity. Company's owner is the shareholder who owns the shares of the company. Here in XYZ Limited, A is the shareholder 1, B is the shareholder 2. A holds 60% of the company, B holds 40% of the company. For 60%, how much money he has bought to the company? He has bought 6 lakh rupees, which is divided into like 60,000 shares of rupees 10 each, and B infuses for 4 lakh, which is consist of 40,000 shares of 10 rupees. Now they bought the company, they form a bank account, and they deposited all this money to the bank. Now the business is growing very well. Every year the business is generating good profits, and that profit is belong to whom? That profit is belong to the owner of this company. Who is the owner? Shareholders are the owner. Who are the shareholder? Here A and B are the shareholders. That is the case one. That is the case of the private limited company. Now let's come to the public limited company, which is the most important discussion where we started this video. Public limited company. So there are, let's say, there are 10 people intended to form a company, which they are like planning to go for a public limited company. Everybody bought 10 lakh rupees each. Each shareholder bought 10 lakh rupees. Basically, they are called as the promoter of the company, the initial shareholders who promote the company. And they decided among themselves that everybody hold 10% shares each. Everybody decided that they will hold 10% shares each. Now, the total company shares is let's say 1 crore rupees, 1 lakh shares divided among 10, which is 10,000 shares held by each shareholder at the face value of rupees 10 per share. Now each and every shareholder has 10,000 shares with them, and each share's price is 10 rupees initially. That initial price of the share is basically called as the face value, which is shown in the face of the share certificate. Now the company, what they do? Now they form a company which is XYZ Limited. Here most important thing, the difference between two private limited and company. One is minimum 2 shareholder, maximum 200. Public is minimum 7, maximum unlimited. Here you cannot, for the case of private limited company, you have to name private limited after the company name, and in the limited company you have to put it just limited. You no need to write private. That is the first concept. Now 10 members agree and they bought the money, the 1 crore capital they infused to the company, and it is in the bank account. Now the second question is that 10 lakh, that 1 crore rupees what they have got in the bank account, they started the business, let's say textile industry, and within the next 4-5 years the company has generated a very huge profit of, let's say, 10 crore rupees profit. That 10 crore rupees is profit. That is the profit belong to whom? That is the profit belong to the shareholder. They either distribute that profit or they keep that profit in the business. When they distribute the profit, it called as dividend, and when they keep the money in the business only, they keep the money in the business because so that it will go for the further expansion of the business, is called retained earning. That is called as retained understanding. Then we will understand the entire life cycle of the stock market, difference between shares and stocks, and as we have already understood what is the company is a company which is formed and registered under Companies Act. It's called a company. And we also understand what is the private limited company and what is the public limited. Private limited like minimum 2 member, maximum 200. For public limited minimum 7, maximum limited. It has to go for the categorization. Now our next question is, for a company prospectus, and now for company prospectus they want to raise more money, they need more money. Now company business is going very well and they need more money. From where they will get the money? So what they decided, the 10 member 10 shareholders decided, the XYZ limited company shareholders decided that we should go for raising money either through private placement or QIP or IPO, initial public offering. They told that as of now we are 10, but if we make this ownership to public and if we allow public to come and take up ownership of the company, then we will get more money from that public. That is the idea behind the IPO. That is the idea behind the capital market. So they went and decided that we will issue the shares to the public. Now the question is, they already hold 10,000 shares each. Now the entire shares of the company is 1 lakh at the rate of 10 rupees per share. Now as they have already grown this business, the valuation of the company has already increased. Means the value of the company is much higher than what they have started in the very earlier stage. Assume present market value of per share is 100 rupees. When the initial started it was 10, but as of now it is 100 because the market has done very good profits, very good sales. That's why the value is increased, and the difference between is basically called as the premium. We call in the technical financial term, we call it the securities premium. Now they decided to raise money to a public. Then picture of stock exchange come. How anybody will give money? Like nobody believe a company. Nobody. They need regulations behind to manage their funds. They need a strict regulation, strict monitoring to manage their fund. Because here it's not like 1 or 2% is involved. Here the lack of people will be investing their money. So what they decided that we will give 20% or let's say 25% of shares of the company, and we will raise the equivalent money from the market. How they can give shares? They already have shares. They already is holding 1 lakh shares. There are two ways. Either they sell the existing shareholder sell the existing shares to the public, or they will issue further shares. Now we have like 1 lakh shares. Now they told like they obtain an approval, they did a meeting, shareholder meeting, and they told let's do increase the shareholder from 1 lakh shares to 1,25,000, and that 25,000 extra shares we will give it to the public at the market price of, as of now it is 100, so that we can able to raise how much money? 2.5 crore, so that they can able to raise 2.5 crore if they are giving extra shares. That money will directly come to the company. That money will directly come to the company. But if the existing shareholders is selling the money, selling the shares to the public, then that money will not come to the company account. When the existing shareholders sell his own shares to the public, called as OFS, offer for sale. You must have understand. You must have heard the word OFS. This is, but in this case, the company decided like they want to go for extra shares. They will issue extra shares to the public, and they will raise 2.5 crore. Before raising the money from the market, there are various criteria that company need to fulfill. It is not like that any company will go and approach to the exchanges or regulator that they want to list their shares. Here the major question is how they will do all these activities, how they will issue the shares to the public, how they will raise money, who will monitor them, how money will come, everything is there. Let's begin. Before listing their shares, company will be buying when they will be raising an interest. Like public will be buying when they will raise an interest. To raise an interest, there should be an offer. There should be offer. We need to give offer to the public. Then only they will know that the company is willing to go for selling its existing shares. That offer is called the IPO. That is initial public offering. That is initial public offering. When the first time company give its own shares to public, apart from the promoters, initial shareholders. To get an IPO, they also need to obtain a permission. There is a very highly regulated body, the Security Exchange Board of India. They need to obtain an approval. They need to provide details about the company, like what the company business is doing, how much money they are generating, how much profits they are doing, where are the business, legitimate nature of the business. Because it is important to qualify the company, because public monies are getting involved there. So the SEBI understand the market, understand the company's business, and they allow for an offering. They give an NOC that you can go and you can do this process. Now the role of exchanges come. Now role of exchanges come. Here I will give a two difference between shares and stock. The two difference, same terminology. Same terminology and the two difference. When shares are available to trade, it called as stock. There is no much difference between shares and stock. When shares are available to trade in the open market, it became a stock. It became a stock. Now the next journey started. Company's next journey started is the listing of shares. So where they will list? They will list in two exchanges possibility. We have very reputed exchange, NSE, National Stock Exchange, and the BSE, Bombay Stock Exchange. They are the one of the various very reputed exchange of the country. So they taken ownership and they told that you can list your company shares to our platform, and obviously they will be taking the listing fees and all. Now they got NOC, they listed the company shares in NSE and BSE, and they raised 2.5 crore. This is just an example. Actual values are much higher. That 2.5 crore been utilized by the company for the further expansion of that business. Now, let's say 25% of the shares are listed in the stock exchange, NSE and BSE, and that 25% share is held by, let's say, various mutual fund, foreign institutional investor, retail investor, other like that. Now, when we trade a shares, means ownership rights of shares move from one person to another. So it is between the person to person who is buying and selling in the particular exchange. There is neither company will be receiving any further money, neither he has to give to somebody. So he has got his money through his IPO. Now, based on the demand and supply, his price will, the market price will, the market participant will decide the value of the company. Yeah, the exchanges. Where does the shares actually trade? Here, what the role of PSE and SE? They, because here the buyer, there is also a buyer, there is also a seller. Then only trade will take place. There should be a buyer and there should be a seller. They match the order and they move this order to the clearing house. If BSE, if order is taking place in BSE, the clearing house is ICCL, and if order is taking place in NSE platform, NSE has its own clearing house. After this clearing, the role of this clearing house is to, like, who is the owner of the company, determining, matching the orders, who is the owner of the company, who has the obligation to pay money, and to whom we have to pay the money. That is the role of the clearing house. Now, after this order after they determine all this obligation and liability, they move the shares to the depository. Depository is kind of like, we have like two very famous depository, like very reputed depository. CDSL and SDL. You must be heard about CDSL and SDL. So they act as a custodian and they keep your shares there in a very safe manner. Here, one important thing we need to include it is the broker, is the broker, role of stock broker. To trade in a stock exchange, you need to be the member. You need to be the member. As to obtain a membership, there is required a very huge capital requirement to obtain a membership. That's why we move through a stock broker who already have the membership. Like I will tell you, like one of the famous stock broker are like like Zerodha, Grow, ICC Direct, HDFC, Motilal Oswal. They are the one of the very highly reputed brokers through which we trade. And to facilitate this trade, we use their platform to facilitate the trade. That's why they collect the fee that is we call as the brokerage. Now we understand what is private limited company, what is public limited company, how the shares are initially divided among the 10 shareholders, and when they issue to the public, they increase their share capital and they issue the shares to public. The public subscribe the shares, given money to public. Now the shares which is subscribed public, it is been traded among themselves. How it is getting traded? It is getting traded in the exchanges, National Stock Exchange and the Bombay Stock Exchange, facilitated by the broker. Then it is going to the clearing house, like when the trade executes, going to the clearing house. Then it is finally going to the depositories where shares are kept in a very secure way. Here, when we start, we will be understanding the various concepts of the market. The most important thing here is market is not to predict, market is to understand. The more you understand, the more you able to generate good money. Even you are not generating good money, if you understand the market, there is a high possibility that you will not lose it. So the most important thing is understanding the market, understanding the overall structure. Now we have already understood the overall structure, how these cycles work. Now we go to the depth of the market, like we'll go for the very fundamental analysis. We must be heard about the terms market capitalization, like market capitalization. So market capitalization is basically total number of shares outstanding. As we uh, understand in the past, total shares was how much? Um, how much? Like we have like how much shares? 12,50,000 shares we thought, multiply with market price. Let's say present market price of share is 200. So whatever the result will come, that is the market capitalization. Means basically the market value of the entire company. It may not be, it may be overvalued or undervalued, but this is the, as the market has decided that this is the value. That is the one concept, is the market capitalization. To determine any company's valuation, it is the one of the very important concept. How do we know some company shares is getting traded at 5,000 rupees, some company shares is getting at 200 rupees, some company shares are getting traded at 6,000, 20,000, 50,000 rupees. The best way to bring all this company into one measurement factor is the market capitalization. Even though you can say the company which is whose shares is let's say 1.5 lakh or 2 lakh rupees per share, doesn't mean it is a very big company. Market size depend on the company size depend on its market capitalization. Even a company whose shares is 200 rupees, that is much bigger than the companies whose share is 1 lakh 2 lakh rupees. That is the most important concept everybody should understand before entering to the market. When we understand this thing, then every shares listed in the market, we will look at just like a in terms of like valuation matrix. Let's say X Limited market capitalization, let's say 10 lakh. So the value of the company is 10 lakh. While limited market capitalization is 30,000. So present value of the company is 30,000 crores, 1,000 crore or 1 lakh crore. So in this way we can able to define which is a small company, which is a medium company, which is a large company. Not by looking into the shares. If you look into the shares price, there will be a very huge confusion. You will unable to determine which is a large company, which is a big company. The only possible methods is the market capitalization. There is also very detailed concept of free float market capitalization, which we will maybe cover in the very next subject, like because it has some technical terms that need to be understood. What is free float market capitalization? However, I can tell you, like it is a shares which is available in the market to trade. Let's say some company has 100% shares. Out of that, 5% of the shares is available to trade. So 5% is basically the free float market capitalization. Then before we understanding and analyzing the balance sheet and P&L, we understand some of the concepts which will help us, like the dividend. As we discussed, when the company generate a profit, either they keep with themselves or they will distribute. When they distribute, it called as a dividend. Dividend like split. Now the company told that now I have 10,000 shares at the rate of 100 rupees. 100 rupees per share. What I will do, I will take a corporate action. As 100 rupees is very high to buy and sell. So what I will do, I will split it into 10 rupees per share, and I will increase my shares number to 1 lakh. Proportionately, it will be given to the existing shareholder who has the shares. Let's say somebody has 10 shares as of now, they will be receiving another 90 shares and price per shares will become 10. So there will be no impact on the value. The right shares means it is the shares given to the existing shareholders. Bonus shares are the shares which are given to the existing shareholder without taking any considerations from the existing shareholder. And right shares are like this person has only rights to buy the shares. Merger and ownership, like these are the very advanced concept we may cover in the next video or next session. Now the most important thing is, like, we get the query how to analyze the business, how to analyze the P&L, the profit and loss, how to analyze the balance sheet, how to analyze the cash flow statement, what is the allocations, capital allocations, and the risk. Now let's say financial reporting. There is company has to govern under Companies Act, where he is required to performance present the performance onto report in a very specific format. Like, as when I'm saying that this is a financial statement where it consists of balance sheet. Balance sheet means it defined the as on date, means as on 31st March 2026 or 27, at the end of the reporting period, what is the asset and what is the liability they have in the company. I mean, how much money they have to give it to outsider, how much money they owe to the shareholder, and how much money they have. Like, either they have in the form of fixed assets, they have in the form of like balance in the bank, they may have in the form of like FDs, banks, balance, investment, like. So this is the balance sheet. Profit and loss account are basically what is the performance for the entire year company has done. People confuse about balance sheet and PL. Balance sheet means as on date, mean as on which date, what is my present status. And the profit and loss for the period means for the entire period, for the entire financial period, let's say 1 year, how much company has made sales, how much company has made expenses, how much profit they have done, how much is profit available, either for the distribution of dividend or for its retained earning. And entire thing is regulated by various body, like Companies Act govern the companies, how the companies will form, how the company will work, what are the rights of the company, what the company can do, what company can't do. SEBI, who regulate the entire process, Security Exchange Board of India, like everybody has to be very fair, like should not do any kind of wrong thing inside the entire the process. So to preserve the public money, exchanges they work in a highly ethical manner. Depositories where we kept in a very preserved manner, very secure way. Then we will understand the investor journey. Like, we have already decided like how the investor journey takes place from initial stage to IPO, then to exchanges, then trading will take place between the investor. Here we understand like legal person. Who is the legal person who own the assets, enter contracts, borrow, sue, and be so. Capital structure. Like, see here, the one way of raise money is the equity market. One way of raising money. Why they went IPO? Because they want more money, they want more public to participate in their business, and they diluted their share. Second, they don't want to dilute their share. They don't want to give company up. They want to give a part of the company. So what they approach to the banks. They approach to the bank and other lender that they need money, and It is a kind of like we took loan from someone, that we call in the financial we call as a debt. As we understand what is the features of the private companies, what is the features of the public companies, are the two different things, like who has the private company, who has the like the public limited company. One point here you also understand, it is not necessary that a public company has to be listed. It can be also be unlisted public company. They can do through private placement and whatever manner, but they do not require to list it. It is on their choice. If they want to list it, if they have listed, then they have to follow the regulation, listing obligations, and they become a listed company. And here, as we understand what it says, it is a one unit of one ownership contract. As we understand a company, let's say entire company ownership is divided into 1 lakh shares, and the person who hold one share, he hold some percentage of that 1 lakh, and that is the ownership right of that company. And each share has one voting right. You must be hear that there should be a voting. Like there are some resolution company to pass. Like some they want to take some big decision, so then they has to go for a special resolutions where minimum 75 percentage of the shareholder approval is required. So in that case, the ownership picture will work. Like I have hold one shares, mean I have one voting right. Then capital structure, who supplied the company's money. Equity, as we understand how we raise the money through equity, through initial public offering. Further offerings are also there that we can also discuss in the later chapter. Like how if after IPO, if company further required money and they want to give the further shares to public, how they will do that. We may cover in the next session. Then second way is they can take long-term debt. They can take you must be knowing about debentures. Must be heard a term called debenture. It's basically an instrument which will be issued so that in the behalf of that public give money to the company, and company has given a certificate, debenture certificate, that we owe this much of money to you. And either in the form of equity or capital or debt. These are the two way of raising money, either through equity or through debt. Here we'll discuss like who owns a company. As we have already covered who owns a company. Company is owned by the founders, promoter, shareholder, like institutional investor, public investor, employees. When you know like ESOPs, when ESOPs are issued, it is not, you are not the shareholder of the company. When ESOPs are exercised, then you became a shareholder of the company. At the time of ESOP issue, you have the right to subscribe to the shares of the company. You have a right to exercise to the shares of the company. You have the right, but until and unless you exercise, you are not a shareholder. So you have just hold the right until and unless you exercise. Public investor. So these are the owners of the company, the founder, promoter. As we learned in the first example, that is the only reason behind to understand the cycle, that later you can able to understand who is the owner. There will be a very clear picture who is the owner, either a founder or promoter. Institutional, when we issue the shares to the public, the institutional came and they took their shares. Public came, they took the shares. Existing employee, we have given the form of ESOPs or like shares, other shares. And directly we have given shares to the employees. Like that, all are the owners. So anybody who holds the shares of the company are the owner, and shares determined by the company, like how much shares, how much of the company ownership is divided into number of shares. That is the entire shares available in the market, entire shares outstanding. It is a total company shares that and the person, those who have that much of shares, they are the owner. The best thing to understanding the ownerships through the percentage, not through the number of shares. Let's say founder has hold, you must be knowing, like a promoter has hold 50% share, promoter has hold 60% shares, so they hold 60% in the company. Institutional, they're like FII, DII, like for an institutional investor, FPI, foreign portfolio investor, then DII, domestic institutional investor, they hold the shares. So they are the shareholders. Public public are the shareholders. So you will get all this information when we go and read the financial statement of the company, basically the annual report. All details are available. Who hold how many shares? How many shares are available? Entire share capital of the company. Who hold how many rights? These are the best things to understand the company. We will keep a very detailed classes in the future, like how to analyze the market, how to study the annual report of the company, where we will uncover the balance sheet, where we will cover the profit and loss account, cash flow, shareholding structures, their business detail. This, it will give us some idea to how to analyze the market. As we have a standard, that is the market capitalization. If we have this information, then we can easily able to read the company. See here, shareholding pattern. The first ownership dashboard. 52% is held by promoter or promoter 2. 14% held by FII, FPI, foreign portfolio investor. 16% held by domestic institutional investor or mutual fund. 18% held by retails or other. As we discussed in the very beginning, dilution. If I am the owner, if I am bringing some other owner, definitely my ownership percentage will decrease, because if somebody is entering to the business, definitely it will, my ownership percentage will get decrease. But overall percentage is 100, but my ownership, existing shareholder ownership percentage will get decreased, because then only I can bring other into the picture. So shares was 100, then we issued new shares, now total shares became 125. So what is the percentage of the existing shareholders? 100 divided by 125, that is the percentage. Earlier it was 100, now it is 100 divided by 125. Here the primary issuance, like new shares are created and sold, company received capital, existing holders may be diluted. As we already discussed, if I am creating new shares and selling, so company will receive the money and existing shareholders percentage will get diluted. And the secondary sales means existing shareholders give their shares to the public who is planning to buy, and there is no change in the percentage, no new money. Basically there will be change in percentage between the existing shareholder, but there will be no new money will come to the company, because that money will come to the shareholders. That money will come to the shareholders, it will not come to the company, because initially that shareholder has already bought that shares at 10 rupees. Now when new shareholder come and he is selling that 10 rupees shares as 100, he will keep 100 with him and he paid the capital gain of 90 rupees in the form of tax, and that money will never come to the company. That's why it need to be very good way of analyzing when there is an IPO and OFS. Why does the company want the public market? As we understand, we need the capital, we need money, that's why we are going to the public and we are bringing the money. Liquidity, like early investor can eventually sell. Liquidity means, let's say I've started the business but I am not much interested now, I want to sell my business, sell my shares to somebody. That's why most in OFS existing shareholder participate and they sell their shares to the new shareholder. Then ESOPs, discipline, regulatory disclosure, create external security. Disciplines, like if they want more regulated, then they go for the public market, because highly regulated, it is a highly regulated market. Then we going public, as we already covered the IPO, the bridge from private ownership to public trading. Prepare business, financial, we have to prepare the financial statement, business report, then file to SEBI for the approval and all. Then we investor education and book building. Then we need to define like these people are interested to buy my shares, because IPO will only success when 90% of the shareholders of the offerings are subscribed. That is the minimum subscription criteria. Then allocate shares to the investor. Then that shares what we have decided will then we will give to the shareholder investors. Then trading start begin on the exchange, and then it will be among us. Like I bought you, let's say X bought shares to X bought shares from Y, Y bought shares from Z, Z was bought shares from A. It's between them. So there is no money will flow to the company further, even though whatever the volume or quantum of the transaction is taking place in exchange. Primary issue, like when the company creates issues in the primary, what they do money, the company can use the money what they do from the IPO is from the capex, mean capital expenditure. They build more plants, they build more technology, they build more research, more capital, like so that they can generate more money for the company. Working capital is basically to run the day-to-day business. Debt repayment, let's say if company already existing has some debt and they are paying, let's say company has a 10 crore or 1000 crore of debt, and now company is paying 12% rate of interest, let's say. Now it is close to 120 crore, and it is a expense to the company. But the company thought that if we raise money from public and we give back that money to the lender, then we can able to save 120 crores, because I need not to give any money to the shareholder. Then they bought that money and they pay back the loan. Then acquisitions, they issue shares and they found that there is a very good company who has a very good potential in future, so they use that money for the acquisition of that company or general corporate purpose, like for their business, like miscellaneous thing. Secondary sales, like existing holders sell existing share, investor to the existing shareholder. Company does not receive the sales consideration, as we have already discussed. The company will not receive the money. Economic effect, ownership change, ownership one person ownership will change and other owner will come to the business. Shares count does not increase, there is no change in shares. Earlier there was 1 lakh shares, now also it is 1 lakh shares outstanding, so no change. Only transaction will take place between new shareholder and the existing shareholders. Money will not come to the company account. This is the important thing you need to understand in the primary issues and the secondary sales. How does an IPO price get discovered? It is seem to be quite technical. We may cover in the next class in a very detailed manner. So it helps to understand how the price IPO will take place, how the investor get bids, the price band get determined, and the finance allocation price are defined. It is based on the demand and supply, because we need issues like we have like we want to issue the shares to the public, but on what price, that has to be determined, and it has to go through some process to determine which price which will be there is a very optimum demand and it could able to subscribe in full. After doing the valuations, everything take place. The most important here is the valuations are also very important. That is a very big concept. Like if you know understand what is the valuation is, 50% of the game will get over. Most 50, 60, 70% decisions depend on the valuation, even more than that. After listing, as we understand, after listing, when the shares are listed when shares are listed, they became a stock. When they became stock, it is between investor to investor transaction. There is no transaction between company to investor. It is an investor to investor transaction. Only shareholding will get changed. So here is a cycle. Investor, let's say you, me, X, Y, Z limited, even any person, HUF partners. Then it go to broker. Then broker is like Zerodha, Grow, then Motilal Oswal, ICICI Direct, HDFC, Kotak, like very reputed other brokers are also there. Then it go to exchange. Exchange is like two bigger exchange, National Stock Exchange, Bombay Stock Exchange, then clearing, ICCL, NSE clearing house. Then go to depository, CDSL, and SDF, where the stocks are actually been stored, safely stored. Inside the market, how a buyer means a sell. Buyer, let's say, wants to buy 100 shares at rupees 500. Seller want to sell 100 shares at 500. Match. Trade price is equal to 500. Quantity is equal to 100. So this way, let's say one is willing to buy some shares. He can only buy when there is a seller. Without seller, how anybody can buy? So that match has to take place. You must be seeing in the capital market that there is only buyer, only seller. I mean, at that time, there are only buyer available, there are only seller available. And even though you place the order, it is an open order. It will not execute it because there are no seller or buyer available. So to execute a trade, there should be a buyer and there should be a seller. You have to visualize all this thing. What I'm saying is you have to visualize this thing, then only you can able to understand the entire concept behind the stock market. Then other concept is bid and ask and split. Bid price is the difference between bid and ask is split basically. Bid is highest price a buyer is currently willing to pay. Ask is lower price a seller is currently willing to accept. Means to here you have to understand. Now A and B are the two shareholders. Both are in exchange. Both are in exchange. A told I want to buy XYZ limited shares, 100 shares at the price of 95. He has placed an order. Now B told I want to sell 100 shares at the rate of 96 rupees per share. Because he is selling, I will only sell when I will get 96 rupees. But why A is saying that I will only buy if the price is 95 rupees when I get a seller of 95. The difference between this bid and ask is basically called a spread. 1 rupees basically called as spread. What is the role of broker here? Like as we hear the name broker, like what is the role and functions of the broker? Like broker handle order entry, client interface, KYC, account relationship, and the execution access. Exchange handle what? Trading volume, matching, market data, and the rule. Settlement layer, clearing plus depositories. They go for complete settlement and they will give money. Who is the obligatory? Who is the to whom they need to make the money? They are the settlement layer. And there is various process. It's not like that's why we have seen like T plus 0, T plus 1. It like trade plus 0 days, trade plus 1 day settlements are there. Settlement take place in trade plus 0 days. Settlement take place in, because after that, when we place an order, when we place the buy and sell order, after the various matching of order take place, then it's go to the clearing house. They determine who is the actual owner, who has to give money, to whom we have to pay money. Then they bring the stock from the depositories and they did the settlement. That process takes place. It is a very detailed process. That's why they take time, t plus 0, t plus 1, to execute the entire trade. The bank depository, the major role they play. They keep our shares stocks in a very secured way. The bank account analogy for securities. Like bank, what bank do? The bank holds money electronically, transfer money between account, provide statement. Your asset is through a bank or channel. In the same way, depositories, like as I told, CDSL and HDL, holds securities electronically, records transfer of securities, maintain ownership record through the depository system. You assess it through a depository participant. Here, DP, depository participant. Through broker, they also became a member of this depository. They also need to obtain a membership of the depositories, and they will get a ID, DP ID, depository participant ID, through which we are able to get all this detail. Investor, like we need three things, like demat account, where the shares are electronically been stored. Trading account, where we able to buy and sell our shares, and the bank account where the money will flow. These are the three important things we need for our investment generally. One is the demat account, trading account, and the bank account. India's two depository, NSDL and CDS. That thing need to be taken care of. Second is settlement. The trade is not finished when you click buy. We place the order. How this way? First is order. When we place the order, then it go to trade order match. There should be a seller, so they match our order. Then they clear. The clearinghouse will do the clearance, like obligation calculated. If this is the amount due from X, this is the amount you need to pay to Y. Then it will go to settle, like cash plus securities exchange. Then only the money will go to seller and the shares will go to the buyer. That the settlement happen. Then securities appear in the demat, basically hold in the depositories, hold by the CDSL and HDL. So even though brokers get changed, our stocks are there in the depositories. We can change our shares from one broker to another broker without doing a trade. Orders, trade, clear, settle, hold. In the secondary market, investor A, broker, investor B. Like secondary market, like where the money will not, company will receive a zero for this particular stock market. Company receives cash when it raises capital through a primary issuance. When there is an IPO, then only company will able to raise money. Otherwise, no money will come directly to the company. It will be between among the investors, like shareholders, I can say. Then now follow rupees 1000 in a primary issue. Investor, company, business use. They use for the capex, like capital expenditure. OPEX, there is one more term, OPEX, like operating expenditure. Debt, like repaying the borrowings, repaying the loans. Working capital, like for the short term, managing the fund requirement of the company. Merger and acquisitions, like buying a new business. Like OFS, as we already discussed, OFS, offer for sale. Existing ownership is redistributed Before, promoter holds 60 shares, public own 40 shares. Now OFS. Holder offer 15 existing shares through the exchange mechanism. After holder is 45, new buyer became 15. Company cash raise is equal to 0 from the OFS itself. The selling shareholder receive the sales proceed, investor receive the shares, and the selling shareholders need to pay the capital gain if it is applicable. If they are liable to pay the capital gain. Then we already discussed what is about the market capitalization, what the market say, the equity was. As we have, let's say, 500 shares price, my present share price of company is 500 rupees, and there are 100 crore share outstanding, means total shares of the company is 100 crore. Then the market capitalization is 50,000 crore is the market, as of now, the market capitalization of the company. I can also say kind of the market value of the company, which is determined through the market, determined by the market. It is a very broad concept. You need to also learn free float market capitalization along with the market capitalization to understand this market very well. The more detail about this concept. Like here, some of the thing are like not enterprise value, debt and cash are not fully captured by the market capitalization. Market capitalization keep on changing. It is a kind of a determining factor. Price change, capital market, even if the business did nothing, it represents the market value of the equity, not the whole operating enterprise. So it determines the market value of the equity, not the entire business, because there are other factors are also involved in the market. Like some company assets might be very high, some debt would be very high. So that need to be adjusted to the market capitalization to determine its the actual value. So free float has an important concept. Like why free float? Like it help to define the liquidity of the business. It says that how many shares is are available for trading, and based on the same, how many shares are available in the open market and available for trading, and if we percentage, if we multiply with the total market capitalization, then we'll get the free float market cap. Let's say some company has 1 lakh shares. Out of that, only 30 are available in the 30% of the shares are available in the market for trading. So free float is 30%, so that it can be easily exchanged among the investor or shareholder. That is important. When we go for the separate classes on market capitalization and the free float market capitalization, then we will understand what purpose that market capitalization could be used and how it could be much more useful. Shares outstanding, the most important concept here. You have to understand what is share outstanding. Let's say authorized. Maximum capital the company is permitted to issue under its constitutional and legal framework. Now you might be thinking like where all are written, like how many maximum shares I can issue to the public, maximum shareholders I can make. That is through the MOA AOA. In MOA AOA, they have defined the two documents the company maintain, the article AOA, Article of Association, and MOA, Memorandum of Association, where they define the rules, regulations, how much shares will be divided into how many numbers. Everything's are written over there. So you can able to understand how much the maximum permitted limit the company can issue the shares. Issues mean out of that maximum permitted limit, how much they have issued. Let's say my maximum permitted limit is 2 lakh shares. Out of that they have issued 1 lakh 25,000 shares. So my issue size is 1 lakh 25,000. Now outstanding, like issue shares currently held by the shareholder subject to the definition used. Treasury or bought back, like how many shares I have bought back from the company, bought back from the existing shareholders. So buyback is a like big concept that you have to understand in a very separate class. That's the basic things that we should not cover this so detailing, or it may create difficulty to understand the what is the process of the buyback. So how to determine the enterprise value? That is the market capitalization plus debt minus cash is equal to enterprise value. EV is a capital structure aware measures used in many operating valuation multiple. So here this factor will come when we go for this valuation concept. To know which is valued or undervalued, then only we can able to determine whether to buy this company shares or not. Without knowing its value, how we will able to buy? But simply going up or going down doesn't define its value. It defines value through its number. The number has to say that this company is this value, and if you are buying the shares of this company, and if this company's values will increase in future, then you will get a benefit. That we got a capital growth. That is why it is important to understand the valuation of the company. If the valuation of the company goes down, so you will get capital degrowth. If the valuation of the company is go up, you will get capital growth. Various corporate actions are dividend and when they distribute the shares, then the bonus issues, split, buyback, rights, merger are the other concepts we have. The dividend, the value moves from company balance sheet to shareholder. When the company has cash, let's say company has made a sales of 10,000 crore, they made a expense of 8,000 crore, and 2,000 crore is left. After that they need to pay the tax on 2,000 crore. After that they decided that whatever the money is left, what I will do, I will distribute it to my shareholder, like owner of my company. Then when the board of the company decided that will distribute this money to the shareholder, board of directors decided, then that money will distribute among the shareholders in the proportion how much number of shares they have hold, based on the percentage, based on the number, and that money will be apportionate among themselves and it will go to them. Then 1,500 crores will divide among all the shareholders. Record date, you must be heard the word record date. Means they need to determine which is my, because shareholding are getting changed every day. They don't know who is the actual owner of the company as on date of dividend distribution. So they define a record date. And in this day, whoever will be the shareholder, we will give money to this shareholder. That's what record date. Then ex dividend effect are there. Buybacks, when the company becomes the buyer of its own share. When the company buyback, let's say 100 shares are there as of now, and the company decided to buy 10% of the outstanding shares. After buyback, company has only 90 shares remaining. When the buyback process, what happened? When they use their reserve, when they use their initial reserves or they issue further shares to buy back their existing shares, and they given back the money to the shareholder whoever participated in the buyback, and they reduce the number of shares outstanding. Now earlier we have like total, let's say 1,25,000 shares are there. Out of that I have buyback 15,000 shares. Now my total shares is 1,10,000, and I have paid back money to all the 15,000 shares which I bought back by the company by using their own money. uh, Three important concepts like bonus, split, and rights. Three different mechanism. Bonus issue: additional shares issued to existing shareholder according to the applicable ratio. Often changes shares count and per share matrix, while total economic value is not mechanically created just by the bonus. Bonus shares mean, let's say somebody has hold 100 shares, and the company decided that we will give two shares for one shareholder. So whoever be the shareholder, they will get additional two shares if they hold one share. If they are shareholder and they hold one share. But the value will be, it's not like that value or money will come to the shareholder. If they hold one share at the rupees of 30, and when the bonus will issue to them to further shares, then the shares price will become 10. So the economically it is 30 become 30 only. If you hold one share, its value is 30. If you hold three shares, the value is also 30. There is no change. And stock split we have already discussed. Like if we are if you are existing shares, if you are dividing it to more number of shares, or like that, a lower denomination or higher denomination, so that would be possible to bring the liquidity in the market. Right issues mean existing shareholders are offered an opportunity to subscribe to new shares, generally at a specific term, unlike a simple split. Like, and they can raise, the company can, in this way they offer to the existing shareholder that, hey, you have hold this much of shares, we are offering, you have a right that you can further subscribe the shares, and with a predefined or maybe some discounted price, or like some preconditions are there, and with this way company can get the money. Valuation: price is a number, value is a judgment. This is an important thing. Like, price is a number and the value is a judgment. We have to define like what is the value of this particular company shares should be the. So there are various valuation methods are like DCF, like discounted cash flow method, PE, relative method like PE, PV, like that. Market based: market price itself reflect the collective market clearing points. No valuation method eliminate uncertainty. Good valuation make assumption visible. You can, with the help of the valuation, you can able to do some good valuation, and you can assume the visibility, like what could be the future value of this company, and able to determine whether it is undervalued or overvalued of a particular company. This is a kind of a mathematical thing. You need to understand it. So you have to use a calculator or the paper and pen to understand like what money I will receive 5 years later. That is not the value as of today. So that need to be determined through the present value factor. That some discounting factor need to be determined, because 100 rupees 5 years later doesn't mean that value will be 100 as of now. That value will be much lesser. Let's say that value is 40 rupees as of now. So we have to, with this method, we have to determine the, if the company is receiving cash flow, means free cash flow in next 10 year or 20 years, and what is the present value, what that value if they are receiving in 20 years, what is that value in my present today, as on today date. That help me to determine what is the valuation of the company, whether it is on undervalued or overvalued. That we can understand in a very detailed concept of valuation, where we cover the discounted cash flow method. Why there is an importance of cash flow? Even though company is showing a good profit, the most important method to determine a business where it is stand is its cash flow method. Cash flow says that how much money they have earned while doing business, how much money has entered to the bank account. That is the actual movement of the cash. Which, if you see the company financial statement, you can able to see after balance sheet P&L there is a cash flow statement where you can see they have divided into three categories. One is the operating, second is the investing, third is the financing. Operating says that how much money they actual cash they get it from the by doing the business. Second, investing says that how much money they got by issuing further shares, by issuing not further like investing, like how much they have invested in the long term project, how much they invested in the equity mark mutual funds, how much investment they made through other company acquisitions, like that, how much where they are doing some capital expenditure, are they are using the big money to build something big, so that that money, that project will give future revenue to me. That can be able to determine through investing activities. And the financing activities means, let's say a company is showing profit but there is no money, actual money is there, so either they are bringing some money from the borrowers or they are making a repayment of out of profits. So what the actual use of that cash flow they are doing, how the entire business cash is moving into the activities. So this way, this is the importance of cash flow to understand the market where the business are generating money, from where they are investing, from where they are bringing to fund all these activities. Like example, a company can report 100 crore profit while customer have not yet paid. Receivable rise, profit exit, cash has not received. So I have made sales, but to whom I have made sales, he has not given money to me. But I need to run a business. From where I will get? I need to obtain a loan. I have taken a loan. That money will reflect in my financing activities. And that cash flow, the receivable has not given money to me, it will reflect in my operating activities. Then you can able to determine the business, how the business are actually been working. Like as we discussed, three operating engine: operating, investing, and financing. Like it is a net change in cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. You can see like how the operating cash flow work is the engine producing cash, revenue, profits, working capital, and the operating cash. Revenue is 1000, EBITDA or profit is 200, receivable is 60, inventory is 30, payable is 20. So my cash flow is 130. And investing activities, here we already explained like where the management placing the investment, where they are doing investment, whether they are doing some capex investment like capital expenditure, like whether they are doing any factories, whether they are involved in developing some technologies, stores, equipment, and other long-term live asset acquisition, whether they are buying a business or like they are doing some strategic exit investments, mean like financing investment, assets purchase and disposal. Negative investing cash flow is not automatically bad. capex growth, potentially value creating if return exceed cost of capital. Empire building, like potentially value destroying if capital is deployed as like somebody has invested a very big money to the project where it doesn't have a good worth, so it is not a good investing activities. As an investor you should look into this prospectus, how the business is actually been doing, from where they are bringing money, from where they are investing, from where they are raising money. These are the important factors to define what the business actually doing before directly jumping to buying any company shares. This help to determine whether we are investing in a right market, right instrument or not, right shares, right company or not. Financing like borrowing, repayment, equity, dividend, buyback, all these things will cover in the financing activities. Like a company don't have money, he has raised the debt, it come under borrowing. Then repayment, company return the debt, become repayment. Equity, they raise further shares, became issues of further shares. Then dividend, it cash return to shareholders, will come under financing activities. Buyback, share purchase, they use the money to buy back their own shares, will come under investing activities. A balance sheet, as we already know what is the balance sheet, company assets and the company liabilities, means how much cash company has, how much receivables company has, how much inventory, plant, property and equipment company has. Liability means how much money they have paid to the outsider, how much money is paid to the equity shareholders or the shareholders. This is the structure of the balance sheet. Asset is equal to liability plus asset. It should always be matched. Liquidity ratio, you can understand this. You can understand this in some very other detail slides we can do. Liquidity has a like very broad concept that need to be understood in very detail. Leverage also need to be understood in very detail. How much risk the company has, lower the leverage. Optimum leverage is basically the company has adopted a very good risk management practice. If it is company has gone for very high leverage, there is a high risk associated with the company. Here profit and loss, you can read the income statement as what about revenue 1000 crore, gross profit 600 crore, EBITDA basically earning before interest, tax, depreciation and amortization 200 crore. After that I reduce what depreciation and amortization, earning before interest and tax 1, and the PBT mean profit before tax became 160 crore. Then after I paid the tax, my PAT is 120 crores, like profit after tax. So actual my cash flow is PAT. This is my actual money. I have done 1000 crores of sales. How much is left after making payment to the government is PAT 120 crore. Out of 120 crore, you need to determine how much actually cash we have realized. Like there could be a possibility of the receivables is there or receivables are there. So out of 20 crore, we should realize 120 crores. So this thing should grow. Revenue, PAT should grow because that is the only sign a business is growing. If business is growing, then revenue and PAT should grow. This is the factor where investors should look and determine, and like let's say historical statement, they say whether the revenue is growing by the company, whether the company is acquiring new market shares, whether PAT is going, whether company has in good capital to invest their business, whether they can go for the capital expenditure. These are the kind of things that need to understand in the financial statement to go for the investing decision. Margin thing, like quite technical, like we can not more relevant, but it is relevant, like how much out of 100 crores 1000 crore, how much is my margin I'm getting, actual margin. Segment like, let's say company, here we can read the segment revenue. Let's say a company called as ABC Limited. ABC Limited, what do? He has a business in various segments. Let's say he has this business in metal, rubber, power plant, infrastructure, etc. That segment revenue will help determine the company in which segment how much revenue company is generating, and this will help to determine the market. This will able to compare with the other competitors, like who is doing better in which business, whether they have a good diversification business, whether they are able to generating, they have made a good diversification, good other segments of revenue, whether what is the consumer base, from where they are selling, whether they are dependent on single buyer, whether they are dependent on single consumer for the procurement, who is their consumer, whether enterprise is the international, how much products they are selling into the international market, how much products they are selling into the domestic market, who whether which class of consumer is buying, like that. So that segment revenue, you can see everything in the financial. When you download the financial report of annual report of a company, you can see segment revenue. You can able to see the clear picture. Vision, mission, strategy is the most important thing to for a company. Like what is the vision, where they actually want to be, where they have started the business, like where they want this business to take, where they can take this business. These are the vision. Mission, what they are currently doing, what is the value they are giving to the present stakeholder as a large. These are the mission. And vision mean where they want to be. Let's say a company who presently is doing business of textile, and they want to become the world biggest manufacturer of textile product. So that is the vision. Mission is what they are doing exactly. They are doing the textile business. They are creating some values to the stakeholder as a large. Management quality, read decision, not just speeches. Like where they are doing investments, where they are allocating money, what is the like good news, bad news, governance, any like any transactions are happening among the management which is prohibited, which has some substantial interest to the, which can harm to the shareholders, like that, that need to be you can understand this through the management report and easily get through the annual report of the company. Business model, where does the company actually make money? Customer, offer, price, margin, cash. Like if I'm selling something, I can make money. If I'm selling something of 100 rupees, 100 rupees is not my money, the margin behind that 100 is my money, and I have to also spend 80 rupees to make that sale, and that 20 rupees, the difference of 180, is my cash. That things to, that is my point. That is the business model of the company. What they are doing, what is the revenue, what is the consumer, what is the direct cost. That as an investor you should, as like if you are understanding the market, you should read the annual report of the company, you read the financial statement, you read the balance sheet, you read the profit and loss account. It may take time, but this is the best way of knowledgeable investing. Regulatory maps, like who and all are regulating the company's law, because it is a highly regulated market. It has to be regulated. Without regulation, nothing will work. So it has to be regulated by the company law, companies act, governance, securities law, sebi, then exchanges rule, like listing, trade, market operations. These are all the rules which are applicable for carrying out all these operations, running a company, going for a listing, issuing the money from the public. Then in because it is a very big market, it's not like a one market, and it's not going to be over in like 1 2 days process. It is a very big process, and even go for the IPO process, it will take eventually 4 to 6 months. Is the very standard times for the IPO. These are the kind of regulations that take place. Company formation, you need to comply with all the company's law, then only you can able to form a company and you can able to sustain a company lawfully. Companies act the legal foundation of the company, the incorporation, like you can able to get the legal entity. Like every company, when they get incorporate, they get an incorporation certificate. Shareholders, like who are the share capital, equity shares or preference shares. Governance, like boards. Every company has to appoint a director who are overall used for observing the monitoring the activities of the company. The board of directors are the person who take care of this. They take care of the boards meeting, disclosures, account auditing. Auditing is also required. They to determine all the numbers are correct, to determine the validity of the transaction, to determine the accuracy of the reports. SEBI, the security market regulator, they protect investors, they develop the security market, regulate the market. The major role of the SEBI is to protect the investor, develop the market, regulate the market. They use for the listing issues, listing LODR list, listing obligations and disclosure requirements. Intermediaries, they manage the intermediaries like broker, merchant banker, researcher, advisors, take over inside trading. They take control of like insider trading. You must be knowing about like somebody has got some information which is not available to everybody. Like certain class of people only know that information. With that information, it could influence the shares price in future. So that is the insider trading. Like before, it's been aware to everybody. Each particular class of people able to determine that, and they can take the undue advantages of that information. This kind of called as the insider trading. Through that information, they have done the trading and they generated a profit. Exchange versus regulator. Who are the regulators? SEBI is the regulator, and then stock exchange like NSE, BSE, clearing and depositories, ICCL, then depository, CDS and NSDL. They are the exchange and the regulator. Disclosure, like public market run on information like financial result. As we have discussed a lot about the annual report and the financial result, they published like every quarter, kind of like limited review reports and the annual report. So every quarter they publish the financial result. As an investor, you should read the quarterly result on every quarter and the annual reports on every year. Material events, they disclose what are the material things they are doing material transaction taken place in the organization. They disclose each and every transaction through the annual report. And shareholding, you can understand the ownership, who are the ownership holding of the company, who are the shareholder, how many holder has hold how many shares. Then you can also see the interest of the shareholder in the particular company. Governance, like board meeting related matters and the compliances. NSDL, CDS and NSDL, depository participant, the ownership, investor, DP or broker, and the depository. Investor, DP, depository participant, broker, and the depositories are the CDS and NSDL. Investor holding securities position, transfer ownership moves through depositories, instruction on the settlements and the corporate action. Securities and the entitlement can be processed through the market structure. These are the like basic thing. Investor, then broker, let's say XYZ broker, ABC broker, then depository, CDSL and HDL. So as a company, as an investor, the best way of analyzing a company is to understand the business model, what the company is business is doing, verify the filing and disclosure, what the company has disclosed through the annual report, diagnose, you have to understand the profit and loss, balance sheet, cash flow, from where they are generating money, how they are generating money, what is the assets and liability as on a particular date, assess the management, assess the who are the management, ethics of the management, everything, and the value, then define the value, intrinsic and the relative value, then decide price versus value. If the value is more, or if the value of the company will go more in future, then you have to invest. If the value of the company will go less, then you should avoid it. This is a process, not a prediction machine. So investing is a process, not a prediction machine. So these are the various red flags you should make an analysis. Now what should analyst should take care of, like profit, cash flow, receivables, debt, frequent equity issuance, related party complexity, or one-off gains. Like profit is going up and up, but no cash flow. Like the money is stuck in the receivables, so there is a risk. Receivables are getting up, no cash flow. Could signal aggressive credit or collection issues. Debt, ask what the borrowed money funded. Like they are keep on taking loan, what they are doing with that loan. Frequent equity dilutions, like issuance, like they are keep on issuing shares and raising money, and it is keep on happening, so the dilutions will take place. So you can take one of the example, case study example here. Cash flow diagnosis, you can take care of the cash flow diagnosis. Profit after tax is 110 crore. CFO is like cash flow from operating is 145 crore. Capex is 90 crore. Proxy is 5 crore. Question 1. Is business converting accounting earning into cash? Yes. CFO is like cash flow from operating is greater than PAT in this year, but we still need the multiple year time to determine this cash flow. These are the some of the simple valuation triangulation, but you have to understand the entire business to determine this actual valuation. Ownership plus capital allocations. Who are the owners? Like promoter, institutions, public. Like you have to see like whether promoter was like promoter shares are getting decreased, whether institutional shares are getting increased, whether public shares are getting increased and decreased, like that. What if the promoter share is getting decreased? What is the purpose? What is the reason behind that? Whether they have done some primary issue, whether they have done some secondary sales, whether there is some corporate actions. These are the some 20 questions, company analysis checklist where you should taken care of. Ten mistakes beginner makes in capital market analysis. These are the all. Confusing market capitalization with enterprise value, because market capitalization is and enterprise value are the two different price. two different values that need to be determined. Looking at PET without cash flow, this is very important. These are the various terms of the capital market: equity, shares, promoter, public shareholder, shares outstanding, free float, OFS, bid, ask, trade, broker, exchange, clearing, settlement, depository, demat, dividend, buyback, right issue, OFS, secondary sale. These are the various important vocabulary. For the zero lab, like 5 lenses before any investment decision: business, do I understand the engine? Do I understand the business? Financial, do the number confirm it? With the help of financial, I can able to confirm what the business has actually been doing. Is the management allocating money well, like capital? Risk, what can break the thesis? And the valuation, I am paying a sensible price. These are the one of the most 5 lens that investors should look into it. And I strongly suggest to read the financial statement. The way we define in the last class, how to in the black past, how to read the balance sheet, P&L, at least some basic information you can able to determine rather than simply buying the company shares. These are the financial recap. Company shares, IPO, exchange, depository analysis. These are the method: company shares, then go for IPO, then go for exchanges, IPO, then depositories, and analysis. The goal is not to memorize the market, it is to understand the market, understand the flow, how the market are actually been working. Official reference point used for this masterclass: Ministry of Corporate Affairs, SEBI, NSC, OFS and Exchange Market Mechanism, NHDL, Investor Guide and the Depository Educational Material, and the CDSL Depository and the Dematerialization Material. And this is for the purpose of the educational purpose only, not a legal or tax or investment advisory. And the more educated we are, the more able to understand the market, the more we able to understand the company, the more we able to understand the financials, we can take a very good potential good decision. You don't need to predict the market, you need to understand the market. So thank you, please subscribe or like for further classes.